Yo, yo! Alrighty, my post-workout chat with you guys. Today we're going to give some mortgage tips and some basic things that you should know. Because as you can see, I'm a loan officer. So here's some basic things you need to know so that way you can get the house that you want. Okay? Now, first off, some of you are going to currently have a home, right? I'm going to tell you guys this right now because I see this constantly because I'm constantly touring houses here in Texas, okay? And this is a very, very, very common trend that I am seeing, and it's leading to these houses staying on the market. So some of you may be homeowners now, and you may be looking to upgrade, get to the next level, get a nicer house, get a bigger house. Maybe your family's getting bigger, whatever, right? You're looking for a home that is more expensive, right? You may have some equity in your house, right? And you're thinking like, all right, now I can afford the next level up, right? I do a lot of tours of homes, do open houses constantly with my wife because she's a real estate agent. Okay. We literally do them every weekend. And I'm going to tell you this right now. If you are currently a homeowner and you are wanting to sell your home and you're here in Texas, okay, and you are in a home that is 10, 20, 30 plus years and you haven't put any money into the house, don't sell your house. Okay. Don't put it on the market until you take some equity out of your house. Okay, get a little home equity line of credit, put some money into your home and update your kitchens, your bathrooms, the floors, the paint, right? Maybe the outside paint, right? Put money into your house. The reason why I say this is because I see this constantly where there are sellers on the market and they aren't doing this. They got a home that was built in 2003, right? And still has the same original kitchen, same original bathroom, same original flooring, same original paint, right? They put no money into updating the house and the fucking thing is just sitting on the market. Okay. It's not selling for months. Okay. And the reason why this is happening is because in Texas, dude, new construction is through the roof out here. I mean, there are literally new homes down the street for the same exact price and brand new. Why is somebody going to spend 400, 500, 600,000 on your old dated house that is, likely to have problems any day, right? When they can go buy a brand new one down the street that's more beautiful, that has warranties on it for the same price. Okay? So your option is get a home equity line of credit. Talk to me about that. I can help you with that. Get a home equity line of credit and put 50, 60, 80K back into your house to make it look beautiful, right? And then your home will likely sell faster for more money because here's what's going to happen. You keep that old dated house on the market and it ain't going to sell for months, right? Guess what's going to happen? You're going to end up having to drop the price of that house 50, 60, 100K, 150K just to get it to sell because the market already sees it ain't as valuable as the current home prices in this area are claiming it is, right? Like I was literally in an open house last weekend. And we were in an open house. It was a nice house, right? It was in fantastic shape for the age, right? I think it was a 2013 model maybe, but it still had the original kitchen, original everything. It was very well taken care of, okay? Very well taken care of, but still overpriced, okay? And I was there was a new real estate agent that was shadowing us, right, as we were holding this open house last weekend. And I was literally just having this conversation with her, telling her how we, do a lot of these open houses and these homeowners are listing these homes that are dated they haven't put any money into and they've been sitting on the market for 70, 80, 90 days and they're not selling because the market doesn't think they're as valuable as the homeowner does, right? Literally just said that, okay? Some people walk in to tour the house. Literally out loud, they said, this home is overpriced. And I was like, I literally just said this. So, tip number one, if you're going to sell your house, okay, especially if you are in the state of Texas, because this area is exploding, okay? There's so much new construction everywhere you look around here. You need to put money into your house if you want it to sell fast and you want it to sell for more money, okay? Because if you don't, you're going to have to drop the prices drastically in order to get to sell. If a house is priced well, it should sell within like 8 days, 14 days. If it ain't priced well, it's going to sit on the market for 90 days plus, okay? Until you drop the price $100,000 and then it's finally going to sell because the market doesn't think your home's as valuable as you do, okay? So that's the first step, okay? So for those of you guys that may be looking to sell your house and then get into another one, fix your house up first. Okay? That's tip number one. Tip number two, when it comes to you wanting to go look for a home, make sure, number one, you get pre-approved first before you start hunting. Okay? See a loan officer. Doesn't have to be me. Go see somebody. Okay? And if you're in a different state, you're not in Texas, I have associates all over the nation. Reach out to me. I can send you somebody. They can actually do this for you. Okay? But anyways, get pre-approved first. So that way you know exactly what home prices you should be looking in, because you don't want to be looking for a home that's up here only to find out later you're only approved for something down here and then you're heartbroken. Okay? Or you're denied altogether. Right? So get pre-approved first. And most agents are going to require this anyways, because agents are commission based. They don't want to waste their time showing you houses only to find out later that you can't even get the damn house, right? So get pre-approved first. So that's the first thing. Now, actually, even before that, here's some things you need to make sure that you do before you even do this, okay? Number one, all your credit cards, store cards, credit cards, everything, card, whatever you got card that's a revolving type of credit, pay them off. Or at the very most, leave 5% utilization on these balance on these cards. Okay. So if you got a $1,000 card or $1,000 limit card, make sure no more than 5% is on that thing. Okay. Ideally, you want it zeroed out. Okay. Before you apply for getting pre-approved, apply for a mortgage, right? Because, the lenders want to make sure that you are not risky, right? And when you start having your cards having high utilization, right? Let's say, especially when you're over 30%, right? That's a red flag. You're likely to get denied. And even if you do get approved, guess what's going to happen? You're going to pay a lot more interest. Okay. So pay your cards down. All right. Off, ideally. Okay. It's another thing nobody ever tells you. That's why I'm telling you this. Pay your cards off. Okay. Also, you want to make sure that your debt to income is ideally below 43%. Now, your loan officer is actually going to configure this and figure this out based off your income and all your debts and all your stuff. Once we punch your stuff into our systems, we actually figure all this stuff out. But you can kind of get an idea where you are just by pure math. Okay? If you make $10,000 a month, all right, all your debts cannot, this is including the new house, okay, cannot be over 43%. Now, there are some lenders that will give you a little bit of leeway, like FHA and things like that, right? But you got to have really good credit. You're going to have more money in reserves, right? Maybe more money down, okay? But 43% is the sweet spot lenders like to see. So if you make 10 grand a month, which most of you don't, I'm just trying to use an easy number, okay? If you make 10 grand a month, no more than $4,300 a month needs to be going towards your debts. This includes your mortgage, your potential new mortgage, okay? And all your other debts, your car, your credit cards, right? Which your credit card should be paid off. I already told you. Okay, this is one of the factors and one of the reasons also why you want to do this, because it reduces your debt to income, your student loans, basically anything that shows up on your credit report is going to be considered like your debts. Okay, so you want your debt to income to be beneath 43%. Okay, that's the sweet spot that lenders want to see. Okay, so if you've ever noticed this, that's like the magic number that if you ever notice, like, you can be making the same amount of money as somebody else, and somebody else goes and applies for a loan, and then they get approved and you got denied. DTI is why. DTI is why. Because your debts were too damn high, too risky for the banks. They said nope. So 43% is the sweet spot, okay, for most lenders. Now, like I was saying, some other ones will go higher, like FHA will go up to 56%, but you're going to have to have typically going to have better income, more money down, more money in reserves, okay, to be able to get 56% limit. So 43 from most lenders across the board, that's the sweet spot. That's like the top end limit, okay, that most of them want to see, okay? So pay your cards off, 43% DTI. So if you're only making $5 grand a month, right, your total DTI is going to have to be like $2,150. That's including your mortgage, your car payments, your credit cards, all that shit, right? Which means your house is going to need to be like about 100 grand, 150 grand, okay? Hey, you're the one that has that income. You want a better house, you need to have a better job, okay? So, but anyways, those are some things that you probably haven't been told. Now, here's some other little things. And I actually just posted, if you scroll down my page, you'll see I just posted about this a little while ago. Another little thing, when it comes time, so let's say all that stuff's good. When it comes time for you to buy the house, okay? Here's how you negotiate some stuff with your real estate agent when you put in an offer on a house. Okay, secret little thing you guys have never heard about that. The new home builders do this, okay? But if you're dealing with a home that is older, right, you can do this too, okay? And so let's say you have a house that is being sold for $450, okay? All your other stuff is good. You've been pre-approved. You can totally buy this house, okay? It's totally within your budget. You go check out this house, right? And the house is, you know, let's say it's like a 2010. They haven't updated the kitchens and stuff like I was just telling you in the beginning. So you think, it ain't really worth 450, even though, you know, it appraised at 450, right? Instead of throwing in an offer for, say, 425, right? Which may offend the seller, right? And then they're going to be like, oh, hell no, and then probably throw you the middle finger, right? What you could do instead is ask for the seller to give you what's known as seller concessions, right? So let's say you were going to ask for 425 instead of paying 450, right? Which is a 25K reduction of price. Instead, offer a request from the seller give you 25K worth of seller concessions. Now, this has to be approved by your lender. You got to have good profile and everything. This is just an example, okay? Seller concessions. Now, what can happen with these seller concessions, which you guys have never heard of, this is why I'm giving you the sauce here, okay? You can take, say, 25K of seller concessions. You could put 15K and have them buy down the rate, right? So now you can say, let's say, for example, the rate of today is 6.5%, which I don't know what it is today, right? Because it fluctuates constantly. Let's say it's 6.5%. You can use 15K and buy the rate down to a 5.75. Didn't know that, did you? Yeah, you can have the seller do that for you, okay? Then you can take the other 10K and have them apply it towards your closing costs, okay? Now, that could potentially wipe out all the closing costs. You don't have to come out of pocket any more money, right? Depending on the situation, right? Because in case you guys don't know it, typically whenever you buy a house, you gotta have money for the down, right? Then you're gonna have, when it comes to closing, you gotta come out of pocket for the closing costs, right? There's all these fees that you gotta pay for out of pocket, right? But if instead you ask for seller concessions, they could buy down your rate with part of it, and they can also apply the rest towards closing costs. Or maybe you don't get 25K. Maybe you only get 10 or 15K, right? Okay. Buy down the rate or just pay for closing costs. Either way, you're going to save some money and it came out of the seller's pocket. Okay? And it really didn't come out of their pocket. It actually just comes out of the profit of the home on the sale. And it's handled at closing. They don't have to write you a check or anything. It literally just comes straight out of like the closing situation. Escrow handles all that. Okay? So they're not actually cutting you a check, what I'm saying. Okay? So there's some secret sauce stuff right there that most people don't know about. Now, a lot of the new home builders in Texas are doing this. This is actually why I'm trying to tell you this, because this is how these new home builders are selling these homes, right? It's because they are actually offering seller concessions, right? The builder's offering, you know, certain things, but you can also ask this and request for this for normal sellers, right? That are selling their house. Okay. So trying to give you guys some sauce for Wealth Wednesday, because the most expensive purchase you're ever going to have in your life is going to be your home, right? Now, ideally, you want to make sure that your profile looks incredible. Your personal credit, the better your credit is, especially like the best rates that you'll possibly get is if you got a 780 score. Okay. Now, as you start getting below that, right? Because even 700 is great, 720 is great, 760 is great, but you're still going to pay a little bit more interest because you're not a 780 plus. Just letting you know. Okay. So, and there's products that you can get even if you got a shitty ass score, like 580. Okay. There is, but you're going to pay more in interest. Okay. So just letting you know that the things are there, but if you want to get the best rates, you got to have the best score. Now, here's another little sauce for you too. Always, 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 which if you follow my original rule, this happens naturally. Because remember I was telling you, pay your cards off. But here's another little factor that you should always know just for your personal credit mastery in general, right? Because not only do I do mortgage loans, I do business lending as well too. So if you have a business or you're thinking of starting one, this is another little factor that you need to know, because when it comes to getting lending for your companies, right? Which you can start an LLC today and have funding within a week or two if your personal credit profile looks good. You always want to make sure that your credit card is paid down before the statement closes. Not your due date, closing date. Okay? So you have your payment due date, and then a few days afterwards is your statement closing date. That's the day they report it to the bureaus. Okay. So always make sure your cards ideally are paid off, right? But at the bare minimum, pay them down below 30%. Otherwise, that's going to fucking drop your score like tremendously. Okay. Now, if you're applying for a mortgage, it needs to be 0 to 5%. So you don't get the 30% leeway. I'm talking about just in general for normal personal credit scores. Keep it below 30% before the statement closes, right? But ideally pay them off. For mortgages, pay the shit off 5% max. Okay. So 5% balance max, right? So if you have like $1,000 limit or $1,000 credit limit on your card, no more than like $5,000 on it. I mean, $500. I mean, what is it? What's 5% of 1,000? I don't even know the math on that shit. Somebody bust out a calculator. What is that? Like $1,000? What is that? $50? Yeah. Something like $50 or $5. What is it? I don't know, but you know what I mean. Less than 5%. Okay. So keep that in mind. All right. Your credit profile is everything. Okay. Everything when it comes to getting business lending or getting your mortgage stuff, because that's going to determine what interest rate and programs that you qualify for. Now, there's another program, which I haven't gone public with this yet, because you have to have stellar credit profile. Now, I'm really waiting on my my California real estate license. I mean, my mortgage license to get approved. Start really talking about this, because California allows this on primaries. Texas only allows it on your second or third properties, right? But there's a special product, but you got to have stellar credit profile in order to qualify for this shit. But this shit is, most of you guys never heard of this product. Okay. It's the number one reason I got licensed, but I didn't realize that Texas only allows it on second or third properties, not your primary, until I'd already gotten licensed and moved to Texas. And now I'm like, oh man, but California allows it on the first. So my California license should be approved any day. Once it is, you're going to see me putting out a lot of content about this product, because it's absolutely incredible. Okay. You've never heard of it. Trust me. Most loan officers never even heard of this product. Most real estate agents never even heard of this product. One company offers this product, and it's kind of like secret because the banks don't want you to know, because with this product, when utilized the way it's supposed to be used, you can literally pay your home off in literally 3 to 5, 7 years, 10 years, depending on your income levels, without making any more money. Okay. Saving your ass fucking hundreds of thousands, or if you're in California, $1 million in interest. Okay. So, but anyways, that's, if you live in Texas and you want to buy a second home and you got stellar credit profile, hit me up. I'm gonna hook you up. Okay. But like I said, most people don't have that in Texas, right? The average person in Texas makes like $50K, right? You ain't got that, right? But to qualify for it, you have to have stellar credit, stellar income, right? Your shit's got to be on point, right? High standards. So, but anyways, those are your little mortgage tips for today. Let's do a little recap. Okay. If you're selling your current house because you want to move into a better house, fix your shit up. Okay. Take some money out of your equity, get a home equity line of credit, and fix your shit up. Otherwise, it ain't going to fucking sell. Okay. Straight up. Okay. Secondly, pay your credit cards down. Make sure your stuff is 5% balance or less, ideally 0. Okay. Make sure you get pre-approved before you start house hunting, right? Keep your DTI below 43%. You do that, you're pretty much going to be able to do this pretty easily. It's going to be pretty seamless for you. Okay. So that is your tips today for Wealth Wednesday. We'll see you next time.